Afternoon, everyone. I'm Alice Mount, the Executive Director in our London office. And we're delighted that you've taken time out from following Davos and also from your day jobs as well. There's certainly a lot to keep us occupied in terms of what's going on in our business lives. Those of you new to British American business, we are a trade and membership association. We're both the American Chamber of Commerce in the UK and we represent the British Chambers of Commerce in the USA. But most importantly, we represent 500 different companies in the UK and the US. And we help manage those relationships out of our offices in London, New York, and Washington, DC. And we just do three things. At the heart of everything is the advocacy for pro-business, pro-trade policies. And we promote trade and investment between the UK and the USA through a variety of publications, campaigns, surveys, and programs, and convening events, over 120 a year, on current issues relevant to our community. And today's Academy workshop is particularly important for US professionals and individuals, families who are dealing with cross-border mobility. Within our membership, we have a really core group of companies who provide excellent services to help in UK, US individuals and families move across the two nations. The panel today are going to walk us through some important considerations around tax and immigration planning. The format today, we've got 40 minutes for a workshop discussion that's going to be broken down into three areas. And there'll be a cumulative about 15 minutes for Q&A. But at the end of each section, we're going to pause and just check with you all in the audience if you have any questions to ask our panelists. And I'd like to encourage you to use the chat function. It's active, so you can put your comments and questions in the chat function. When we get to the Q&A sections, just use the raise hand function, and then the respective speakers can come to you and ask you to ask your question in person. We'd welcome you to keep your screens, your cameras on so we can see you, get some feedback from your faces and reactions. And then also keep yourselves muted if you don't have a speaking role. We brought three BAB members together today who've got some excellent knowledge and expertise in those key areas around the mobility. We have Kenzani Mathabula, attorney and expert on US immigration, with her colleague Jennifer Stevens, managing partner and expert on UK immigration. They are both with Laura Devine Immigration. And then we have Hunter Norton, partner for Farku, Furman and Faccio, who will cover tax, accounting and legal issues. Jennifer's going to get us started. So without further ado, let me hand over to you, Jennifer.
Mm-hmm. Thank you so much, Alice, for the introduction. It's a massive pleasure to be partnering with British American Business on this webinar and workshop. And thank you all for joining. We're looking forward to the discussion. Basically, we've come together to discuss immigration and tax today, which we felt were two key areas for any cross-border move. And they also seem to be regularly in the headlines at the moment. So we'll be looking at policy developments on the US and the UK immigration side, as well as exploring just some of the various immigration routes available, at a high level. Hunter will be discussing tax planning, so pre-arrival, and tax principles post-arrival in the US. As Alice said, we are very open to questions throughout. It'd be great if this was interactive. Please put your hand up or put your questions in the chat, and we'll be monitoring that throughout. So I think let's get started. I will pass over to my colleague Kenzani on the US immigration side.
Thank you, Jenny. Hi, everyone. So I will be covering the visitor and work visa options on the US side, as well as long-term pathways, as well as I'll be touching on a few of the many developments that are shaping US immigration right now. Can I ask for my slide to be put up? There we go. Okay. All right, so the next slide. So I'll start with short-term business travel. Um, as many of you would know, you can travel without a visa on ESTA, so that's the visa waiver program. You must be a national of one of 43 countries. It allows you to travel to the US for 90 days or less. However, if your answer is yes to any of the security questions that have to do with previous immigration issues or any criminal background, then you'd have to apply for a B1, B2 visa. So B1, B2 visa is a visitor visa, and it allows you to travel to the US for business and tourism. They are usually issued for 10 years. But the permissible activities on a B1, B2 visa include consulting with business associates, speaking about investment opportunities, attending meetings or conferences. But very importantly, you cannot do any productive work on ESTA or on a B1, B2 visa. You must have a work visa, which brings us to the next slide. Okay, so I'll start with the H-1B visa. It's probably the most commonly known work visa. It is for individuals with specialized knowledge. So you must have a highly specialized knowledge and a bachelor's degree in your field as a minimum for entry. There are caps on this visa type, so 65,000, apologies, for bachelor's degrees, and 20,000 for individuals with master's degrees. And because it's capped, there has been a lottery system for the most recent years. And this year there are a few changes. So there is an increased filing fee of $100,000 for individuals who are outside of the US entering on an H-1B visa. And also they are changing the lottery system. So it will be organized based on the prevailing wage system. And basically that just means that individuals who have a higher salary will have a higher chance of selection. You file the petition, well, the lottery usually happens in March. If you're selected, you file the petition starting April 1st, and there is a start date of October 1st. Next slide. Okay. E1, E2 visas, these are such a great option for individuals who are able to apply. So you must be a national of a treaty country. This visa type is based on treaties that the US has with particular countries, such as the UK. So you must be a national of a treaty country, and the company must be majority owned by treaty nationals. For the E1 visa, which is for trade, you must have a continuous flow of transactions of time, and the majority of the trade must be with the US. Versus for an E2 visa, you must make a substantial investment to the US. There is no minimum requirement, but the money that you spend must be at risk. So you must actually make the investment. You must also have a business plan and show your financial projections for the next 5 years and hiring projections. Next slide. E2 visas are issued usually for 5 years. It depends on the country, but for the UK, they are issued for 5 years at a time, although you are admitted entry for 2 years at a time. And in order for individuals to go to the US on an E2 visa, or an E2 visa specifically, you must have one of the following roles. So either you must be an investor, an executive supervisor, or be a specialized knowledge or an essential employee. And once the company is registered, so some embassies have a registration system where you first register the company as an investor company, and thereafter it's quite a streamlined process to send employees to the US, but they must also be of the same nationality as the company. Okay, next slide. Then we have L1 visas. So these are for intercompany transferees. So for this visa, there must be an entity in the US and an entity abroad. There is an exception for new offices, but usually that looks like a parent subsidiary or an affiliate relationship between the entities. And the individual must have been working abroad for at least 1 year in the preceding 3 years before being transferred to the US. For a new office visa, so this is when you're sending an employee to establish the office, then you don't have to have necessarily the US entity running, unlike with standard O1 visas, but the individuals who transferred must have one of three roles, either a managerial, executive, or specialized knowledge role. These visas are usually issued initially for 3 years. For O1A visas for managers and executives, you can extend them in 2-year increments up to 7 years. And for O1B employees, you can extend them up to 5 years. For a new office visa, they're initially issued for 1 year, and then you can extend them. Next slide. Okay, now we have O1 visas, which a lot of people also know. So these are for individuals with extraordinary ability. So O1A visas are for individuals in the arts, education, business. O1Bs tend to be for individuals in the performing arts, as well as motion picture and the TV industry. You must either show that you are the recipient of a major internationally recognized award, such as a Nobel Prize, but of course, not many people meet that requirement. So if you are not the recipient of a prize like that, then you have to show that you meet at least 3 of the other requirements. So lesser known examples would be lesser known awards, press coverage, publications, original contributions in your field, if you've judged the work of others, or if you have held critical roles at organizations with a distinguished reputation. Next slide. O1 visas are very evidence heavy, so we need as much evidence as possible. You must also have a US-based petitioner, whether that's an employer or an agent. And O1 visas are usually issued for 3 years, and they can be extended in 3-year increments if you show that you have new events. So specifically in the performing arts, you have to show that you have an itinerary of work. So you're not only establishing that you have extraordinary ability in your field abroad, but that you have work lined up in the US. Next slide. Okay, so just common things to watch out for is USCIS can issue what is called a request for evidence. And that is when they are not convinced that you meet one of the requirements, it then gives us or you the opportunity to respond and to provide the additional evidence that they request, and then they would then process the application. For US immigration, it can take a long time. Standard processing times are 6 months or more, so it's quite critical to plan well in advance. However, there's the option to pay for premium processing. The current premium processing fee is an additional fee of $2,805. But in the instance where you apply with premium processing and you receive an RFE, once you respond, USCIS would have another 15 business days to then adjudicate your case. There are also site visits that apply to certain cases, such as O1A visas, also R1 visas for religious workers. Also, be mindful to check your I-94 record. So on a non-immigrant visa, when you enter the US, you will be admitted in the appropriate status, and your I-94 tells you when you need to leave the US by. Vitally important that you check that. Sometimes they make mistakes, and so we have to request that they correct your I-94 record. Importantly, if you overstay in the US which you should never do, but if you were to overstay for more than 6 months, when you leave, you trigger a 3-year ban. And if you were to overstay for more than a year, you would trigger a 10-year ban when you leave. And then in terms of dependent visas, spouses of immigrants on an E2 and an L2, spouses of immigrants on either an E2 visa or an O1 visa are able to work, but spouses of immigrants on an O1 visa cannot work. And then you also have to just be mindful of children who age out at the age of 21, so you need to have a plan for them at that age. Next slide. Okay, so we've reached green cards, which are immigrant visas. So this is if you wanted to stay in the US permanently. There are 3 different categories. The EB1 category is first preference. It's for individuals with either extraordinary ability individuals who are outstanding professors and researchers, and individuals who are multinational managers or executives. It doesn't require a labor certificate, unlike the EB2 category, which is for individuals with an advanced degree or a national interest waiver. And EB3 is for individuals who have either a degree or lesser experience. For EB2 and EB3, you have to go through the PERM process, which is basically a multiple month process of showing that the US company cannot find any similarly qualified US citizens to fill the role. And then, of course, EB2 and EB3 are subject to the visa bulletin. So you're looking at multiple years, usually, for both the EB2 and EB3 categories. And then lastly, I'll mention family-based immigration. I don't have time to go through it, but that's if you have a US citizen spouse, you can then petition for their family. Okay, next slide. Okay, so there are so many policy changes in US immigration. There are countless executive orders. Unfortunately, I won't be able to go through all of them, but just to touch on a few. So we have many travel bans. There is a travel ban for nationals of 19 countries, so that's a full ban. There are also partial restrictions for countries that basically the US is applying additional vetting. And then as of today, there is a travel ban on 75 countries, and it's a suspension on immigrant visas. So important distinction, immigrant visas are green cards, so for permanent residency. They don't apply to non-immigrant visas for nationals of these countries. There are also visa bans for travelers from certain countries who are applying for a B1, B2 visa. At the visa interview, a risk assessment is made, and a bond of $5,000, $10,000, or $15,000 is applied. We touched on this briefly earlier, but there are changes to the H-1B system. So for fiscal year 2027, the lottery, the dates have not been opened yet, but usually the lottery is in March. As I mentioned, the Department of Labor is applying a new prevailing wage system. And so just generally, there are 4 levels, and depending on how much depending on the appropriate salary, that will determine how many times your your entry is entered into the lottery. And so employees who are paid more will have a higher chance of selection. And then we have social media vetting across visa types, specifically student visas, and also ESTA applications. And just mindful of time because we need to cover a lot more. We also generally have seen net immigration drop sharply. But I will say that we are still seeing a lot of interest for investor visas, L1 visas, O1 visas. So by all means, on the business immigration side, there is still a lot of interest of individuals still seeking to work in the US. I will pass it on, I believe, to Jenny.
Yeah, I do. I just noticed a question in the chat for you, Kenzani. I think there's a question from Anna. If you were here on an E2, originally applying in the UK, you're now in the US, do you have to pay the $100,000, sorry, the whopping fee for transferring from an E2 to an H1B? I think there are quite a few questions around this, aren't there? It's confusing.
Absolutely, it's quite a staggering fee. So we have been looking for clarity on this point, but currently, the understanding is that if you apply while you're in the country, so you file a change of status from one non-immigrant status, such as the E2, to the H1B, then the fee should not apply to you. Versus if you were to leave the US and then apply for an H1B and enter, then the $100,000 fee would apply. Of course, my pleasure.
So just checking, I don't know if there's anybody who has, obviously there'll be a Q&A at the end, but has any more questions for Kenzani on the US immigration? Can't see any hands raised. We will move on, but please do share if you have any questions coming up. So we'd intended to pass to you, Hunter, to talk on the tax.
Thank you, Jennifer. It's nice to be here with everybody. Let's see. I'm trying to bring up. Can everyone see my screen now? It's coming up.
I don't think we can see your slides, Hunter.
Okay. All right. Okay. So could you control it on the other end? We'll go the first. Okay. Very good. Let's see. All right. Well, thank you very much. Sorry for the delay. I'd like to talk about the tax consequences associated with coming to the U.S., relocating here. And there's kind of broken it into two general categories. A little bit about pre-arrival planning. We can come to the next slide, and then we'll talk about the year of arrival and a little bit about, after that, the tax consequences on a go-forward basis. So prior to arriving, considering that the U.S. has, a vast tax network and is going to, once you become a resident, you're going to be taxed on everything, as we'll discuss. You may want to consider some planning to, minimize tax consequences while you're here. So to the extent you have appreciated positions, you may want to consider selling those in the market and buying those back at a higher basis, so that if you want to sell later on, now if that's going to generate a large gain in the UK or in another jurisdiction, that's not necessarily what you want to do. But if you have a low tax rate in the UK, you may want to consider doing that. Possibly talk to your advisor before doing that, UK and US advisor, as to what the tax consequences would be. Another matter that's more of trying to avoid kind of unexpected complications in the US is disposing of foreign mutual funds or investment funds. These are not really favored in the US. They require special reporting, and if you don't get proper information for the funds on a current basis, can be very punitive to own these. So it's just easier to dispose of those prior to becoming a U.S. tax resident. Now, if you have substantial interests in foreign businesses or corporations, due to other reporting requirements, it may make sense to consider transferring. It's not mandatory to say a relative who's not a U.S. person, and sort of avoid having to report those while you're in the U.S. One last thought is you may want to consider accelerating income recognition. For instance, if you could take a distribution from a deferred compensation plan or exercise stock options, these would otherwise be taxable events in the U.S. If you do that prior to arriving in the U.S., you would avoid, dealing with U.S. tax consequences associated with that. But of course, again, you should discuss it with your UK tax advisor and possibly US tax advisor before doing that. Can we go to the next slide, please? So upon your arrival to the US, the key question is going to be, for the year of arrival, what status will I have in the US? Will I be, for the whole year, for part of the year, will I be a resident, a tax resident? Will I be a non-resident? And this has, depending on which category you are, as we'll see, has significant tax consequences and tax reporting obligations. So let's go through how you could be deemed a resident in the US in your year of arrival. Now, if you happen to be one of the people who has applied for permanent residency status, Kinsani talked about the green card, and you apply for a green card. As soon as you're issued a green card, I realize probably most of you on this call would not be looking for a green card, perhaps initially, but as soon as you're issued a green card, you're considered a tax resident of the US. And even if you're not living in the US, until you relinquish that green card, you're a tax resident. You have to report in the same way as any other US person or US citizen. And the main way in which most individuals will be classified as tax residents is under the substantial presence test. You may have heard of this. This is a day count test that in the year in which you're trying to determine residency, you count your days of presence, any day, unless it's an special exempt day. And generally that requires have a special visa, and we'll talk about that in a minute. But generally, any day of presence in the US counts towards the 183-day limit. And once you hit 183 days or more, you're considered a US tax resident. Now, this test has a certain look back that adds in days from prior years, they're deemed days, and counts towards that 183-day test. So in the year in which you're present, every day present in the US is counted as one day. In the immediate prior year, any day you were present in the US is counted as a third of a day. And then looking into the second prior year, any day present in the US is counted 1/6 of a day. So you would add up the sum of those amounts, and if you're 183 days or more, you'd be considered a US resident. However, there are exceptions. For certain types of visas, those days in the US do not count. That won't be the average person. These are going to be the exceptions. So categories of individuals that are days that do not count towards the substantial presence would be employers of a foreign government or an international institution such as the United Nations. So if you're a government, if you're working for your government, those days can be exempt. Certainly, I've done work for people that work in the UN. Our office is actually very close to the UN in New York. A key one are students. For a certain number of years, students that are present in the US, those days are exempt. They're not counted towards tax residency. They're considered non-residents. Another one is teachers and trainees. For a certain number of years, teachers and trainees are considered, those days are considered exempt from the substantial presence test. Now, another way in which you can avoid residency status is through an exception in the Internal Revenue Code called the closer connection exception. And this involves, you have to meet certain requirements. One of those requirements is that you cannot, in the year in which you're trying to determine that you're not a resident, you cannot have actually been present in the US 183 days. To use this test, you would use in a situation in which that day count test using prior year days, the aggregate of those days exceeded 183 days. And if that's the case, it's possible that under the closer connection test, you can be considered a non-resident. But the other requirements are that you need to have a tax home in a foreign country for the entire year. So a tax home is a home of where your economic presence is or where your employment is. And the other main requirement for this is that you need to actually have a closer connection to a foreign country. So you need to have where you vote, where your driver's license is, where your personal belongings are, certainly where you have a permanent home. If you can make the case that during that period you had a closer connection or during the year you had a closer connection to a foreign country, then notwithstanding the 183-day test, you could be considered a non-resident. So what type of people could this apply to? This could apply to, say, business travelers that really live in a foreign country but are spending a lot of time in the US trying to drum up business. this could apply to people that have vacation homes in the U.S. that, really are coming here for, they maybe come to Florida for certain times of the year, but generally live in a foreign country. Another way in which you can avoid residency under the substantial presence test is through a tax treaty. And this is very similar to the closer connection test. And basically, under a tax treaty, you can use that in lieu of the closer connection exception if you're considered a resident under the substantial presence test in the U.S. and you're considered a resident, and you're under the treaty because you're a citizen, say, of that country, under something called the tiebreaker provisions. If you can establish that, your permanent abode is in a foreign country and your center of vital interests, where your economic connections are in a foreign country, and other things and other aspects that are closer personal exist in the foreign country, then under the treaty, you'll be considered a non-resident, and that will allow you that'll supersede the code status of residency, and you'll be able to treat yourself as a non-resident for filing purposes. Now, in situations in which under the substantial presence test, you would not be considered a resident of the U.S. year of arrival, such as, when you did the day count and you could not come up with 183 days, there's a voluntary election called a first-year election that you could make. This has its own counting scheme. So in order to make this voluntary first-year election, you need to be present in the U.S. for a 31-day consecutive period is the first requirement. And the second requirement is during the period, the 31-day period, from the beginning of that period until December 31, you need to be present in the U.S. for 75% or more of the days during that period, starting from the beginning of your most recent December 31-day period. And if you meet that test, you can make a voluntary election to be a resident of the U.S. And we'll get into why that's advantageous. Generally, there is a tax reason. It's not necessarily, we'll see, for advantageous for a single individual, or it could be in some limited instances. But for a married individual, it can be very advantageous to make that election. So moving on to the spousal election, in some instances, neither spouse meets the substantial presence test. So one or both spouses may want to make a voluntary election. However, in order to get a benefit in the Internal Revenue Code of taking the standard deduction, we'll talk about it more, you need to make another election. So it'd be two elections that a couple might make. They might make, for each person, again, might make a first-year election, and then they can jointly make a spousal election. And if they make that, if one spouse is a resident alien at the end of the year, if both spouses make the election, they can treat each other both would be treated as if they were residents for the entire year. And that would enable them to file a joint return and obtain the benefits of the standard deduction. So if you could go to the next slide, please. So let's talk about when residency starts. In the case of the green card test, it's simply the first day you're present in the U.S. while you have an active green card. It's not the first day you're present in the U.S., it's when you have the green card. Under the substantial presence test, generally it's the first day of presence in the U.S. However, it does allow for a certain number of days, considered nominal days of presence, up to 10 days, that you can disregard. So if you're coming to the U.S. on travel, scouting out where you'd like to live, and you come for 7 days, your residency, when you ultimately come permanently, you would not start your day of your first day of residence as of the earlier days when you came into the US, but rather when you permanently arrived in the US. If you choose to make the resident alien election because you would not otherwise be classified as a resident alien, the first day of the earliest 31-day testing period would start your residency date. And under a tax treaty, you look at your residence, you look at whether you're considered a resident of one country or another under that tiebreaker rule to which I just referred on a day-by-day basis. So at some period, you'll move and your abode will change, your permanent, where you live will change. And so prior to the period in which you actually move to the US, you can establish that you're a resident of one country. And then after you do move to the US, where you're permanently residing, you become, under the treaty, a resident of the new country. And so you would look to when that move takes place under the tax treaty, and that will allow you to establish your first day of residence. Can we go to the next slide, please? So now that we've talked about your classification of residents versus non-residents, let's talk about what does that mean for tax purposes. So non-residents are taxed on US source income and US trader business income. So what does that mean? So US trader business income encompasses not only if somebody is conducting an actual business in the US, but it also includes if you're working providing services as an employee in the US. That's effectively US trader business income. And US source income is generally going to be, in a non-business context, it's generally going to be income paid by a US corporation or other US payer. So interest paid by a US bank, dividends paid by a US corporation, intellectual property utilized in the US. This will be US source income. Those are the only types of income that non-residents would be sourced on. Now, there are other taxes that apply to non-residents. These would include, notwithstanding these on your employment income, you're going to have Social Security. So that's it's equivalent to your national insurance contribution. Social Security and Medicare, those are two taxes that sort of lump together. They total about 7.65%, and you're taxed on the first dollar that you earn. That's only on until you get to, that's for a non-resident, that's only on your earned income in the US. Another type of income another tax system is not only the federal tax system, federal income tax system, but the state income tax system. So even as non-residents, if you're earning wages in a given state that has an income tax, you will be subject to state income tax in that state. Now, residents of the US are taxed on their worldwide income. So that means income, if you worked in another country, wherever it is, if you have source income that's paid by a foreign corporation, dividend income from a foreign corporation that's taxed in the US, as well as your US source income. Now, non-residents are not allowed to take the standard deduction, and they only take itemized deductions. Why is this an important point? It's important because the standard deduction is actually a very significant amount. For married couples in 2026, it's a little over $32,000. And for single individuals, the standard deduction is $16,000. So those are straight deductions against your income that lower your effective tax rate. Non-residents are only allowed to take certain itemized deductions. They can't even take all itemized deductions. So the type of itemized deductions non-residents can take are state income taxes that are associated with their wages. They can take charitable contributions to US charities and certain casualty losses. Other than that, they're limited. Residents, as we just talked about, can take the standard deduction, or if their itemized deductions are higher, they can take itemized deductions. And additional itemized deductions a resident could take would be deductions for mortgage interest, deductions for real estate taxes in the US, deductions for investment interest. Those would be additional deductions available to residents. So unmarried individuals who become residents partway through the tax year are classified as, quote, dual status aliens. That means that they're a non-resident for part of the year and a resident for the other part of the year. Why is this important? This is important because if they're unmarried, you have to be a resident for the entire year in order to take the standard deduction. So you're still, even though you're a resident, you're still going to be limited to itemized deductions. Married individuals who become residents partway through the year, as we discussed earlier, can potentially make the spousal election. And in doing so, they would be a resident for the entire year, would allow them to take the standard deduction, which for married individuals over $32,000. Well, what is the cost or downside? They have to pick up all of their income worldwide from the beginning of the year. So they worked in the UK in the first part of the year, they need to report that. They had other foreign source income earlier in the year, they have to report that on the US tax return. However, that's the tax cost of that is mitigated because the US provides a foreign tax credit that offsets foreign source income, tax on foreign source income. We go to the next slide, please. So another burdensome aspect of being a US resident, a tax resident, is that, and that this does not apply to non-residents, is there's a myriad of potential reporting requirements. Now, not all of these will apply to the average person. However, first and foremost, I draw your attention to the bottom of the page. FinCEN Form 1114, Report of Foreign Bank and Financial Accounts. So this is the financial crimes department of the Department of Treasury, or division of the Department of Treasury. And once your foreign bank or foreign brokerage accounts, if you're a U.S. resident and they exceed $10,000, you must file this form. And it's not much to report. It's simply reporting the name of the bank, the highest balance during the year, and the account number. And there's no automatic audit associated with that, but you need to report that on an annual basis. Now, other forms that can apply are if you have foreign assets similar to the ones we discussed, you have an interest, just small interest in a foreign corporation that's not held in a brokerage account, or a foreign partnership, and your total assets are above a certain threshold, you need a file form 8938. That's a FATCA form. I won't really go through these others, but they generally just, if you have significant positions in foreign corporations, foreign partnerships, if you're the beneficiary, receive a distribution from a foreign trust, you have to report the distributions. If you receive large foreign gifts within 1 year, or large inheritance, you have to report that. And as we talked about, if you have a foreign mutual fund, there's special reporting associated with that. So with that said, does anybody have any questions? If you go to the next slide, please. Okay, well, I guess if there are no questions, I'll turn it over to Jennifer to talk about immigration.
Yeah, thank you, Hunter. I will try and leave a bit of time at the end to go through any questions for the two speakers. But I think from what you were saying, Hunter and Kenzani, I think it's key to consider immigration and tax well in advance of any anticipated move. There's obviously a lot involved, and you have to work in that timing. But I did want to touch on UK immigration and some changes we're seeing on that side. So if you can share my slides, please. Thank you so much. If you just go to the next one, this just covers the agenda. I will make it quite brief. I am conscious of everyone's time. But there has been a lot going on the other side of the pond. So for anyone looking at a potential alternative to the US, I am going to be touching on some of the UK's recent and upcoming changes. And then I'll just briefly mention some of the available immigration routes that we have. So if we can move on to the next slide. So I did want to first cover the electronic travel authorization. So as many of you know, or probably know at this point, it was first announced back in 2023, and it has been phased in gradually since then. So the ETA is a digital authorization. So this is linked to your passport, and it authorizes you to travel to the UK for up to 6 months. So there has been a bit of a grace period so far that they haven't been enforcing this, but it will be enforced from the 25th of February 2026. So a big reminder to everybody looking at going to the UK who is not British, not Irish, doesn't already have an immigration permission, you will need this ETA. You may not even be able to board the plane. So please make sure you have this ETA in advance of any travel. Sometimes it's instant when you apply for it, sometimes it takes a little bit of time. So please factor that in. So to stress that it's not an immigration permission, it's kind of a pre-clearance, so similar to the ESTA on the US side. It really is for, visit purposes, so you can do really quite basic things in the UK, like tourist activities. One of the main questions we've been receiving is from British nationals. So there may be some on the call, you're British, you live here in the US, you're also US, and you have that passport. Can you just travel to the UK on your US passport? No, you cannot. You need to renew your British passport. So similar to the US, you should be traveling to the UK on that passport. If you travel on your US passport, they're going to ask you for this ETA. You cannot be issued an ETA if you are British. So just wanted to stress that. Happy to answer any questions, but I will move on to the next slide for the time being. So some policy developments really that have been happening over the last year in the UK. So the government released the immigration white paper back in May last year, which was the blueprint for Labour's immigration policy for the coming years. So similar to what Kenzani was talking about earlier on the US side, there really has been a drive to reduce net migration. So the core objective of this white paper was to do exactly that. So there were net migration had really been rising over the years, particularly post-Brexit, where changes were made to the rules to try and address a loss of the EU workforce. So that was a real concern. The government made it a little bit easier to get visas, and that brought the net migration numbers up. So this white paper brought in restrictions, or restrictions were brought in post this in various routes. So we saw skill level being increased, English language level rising, the cost of UK visas rising. So all with the aim to limit the numbers coming into the UK on visas. And it also first introduced this concept of earned settlement. So this is basing eligibility for settlement in the UK, otherwise known as indefinite leave to remain. So kind of similar to the US green card. So basing that eligibility on an applicant's contribution to the UK and looking at increasing the qualifying period from 5 years to 10 years, which is going to have quite an impact. So then came the earned settlement statement and consultation back in November. This set out more detail for the earned settlement model. Brought various questions in, and this consultation is currently ongoing. So if we can have the next slide, I just wanted to cover a few of those points a bit further because I think this is going to have quite an impact on potentially people already in the UK, although that's not yet clear. But I think for people considering whether to go to the UK, whether that's an option, because this is really increasing that period for getting that settlement. So I've covered some of the key proposals. So for anyone on this call already in the UK who may be a little bit concerned about this, there are ways of reducing that qualifying period from 10 years to potentially 5 or 3. The consultation closes in February. And then we anticipate potential rule changes from being published in mid-March, maybe even being phased in as early as April this year. So watch this space. There will be more information coming out. We'll be sending e-shots around this to anybody on our mailing list. So please shout if you would like us to add you. So moving on to the next slide. I just wanted to make everybody aware of some of these key immigration options available in the UK. So the skilled worker route is one that we see utilised probably the most regularly. It's a sponsored immigration route. So you do need a job offer that company in the UK needs a sponsor license to sponsor you. You can then get a visa. So although it is a good route that can also be used for intra-company transfers, so if your employer potentially here in the US is looking at transferring you to the UK, you can use this route. Also good to note for anyone who is here and looking at the H-1B this year and potentially doesn't get that in the lottery, this could be an alternative. If you can't stay here, maybe your employer can send you to the UK for a year, 2 years, with the potential of coming back to the US. So we see this utilised quite a lot in those situations also. Next slide. So I'll very briefly touch on the expansion worker. This is if you're a senior employee or specialist, senior manager or specialist employee, and your employer wants to send you to the UK to open up a business. This is often a quicker way than the skilled worker if the company is not yet trading in the UK. It just needs that footprint. So you get the provisional license and then ultimately you are going to be going on to the skilled worker route. So moving on to the next slide, which is high potential individuals. So for a lot of graduates in the US, this is a great route to get you to the UK. It's 2 years, gives you that period to be there, good flexibility. You can work for anybody, but you must have graduated within the last 5 years from one of these top global universities. There's a lot of US colleges on this list. So this is a very good option. Have a look. If you're qualifying, it's great, and you don't need that sponsorship. So now on to another immigration option that also doesn't require sponsorship is the global talent route, which is the next slide. You can apply if you're exceptionally talented or if you have exceptional promise. So you're not yet a leader in your field. You need an endorsement initially from one of the endorsing bodies, and you can then get your visa. Very flexible. You can work within your field or not necessarily, but you need some UK earnings within your field to extend. But we are seeing more and more applications within the digital technology sector. So those who are potentially transferring their business to the UK, they may qualify as an individual under this route, and this is a good option for them. And then finally, we have the innovator founder route on the next slide, which is really specifically for entrepreneurs, but for those who have an innovative business. So innovation has to be at the core. It has to be viable and scalable. You get that endorsement initially, and you can then get your visa. It's a little bit more restrictive than the global talent. You're having to work within your business. And the bar is quite high in terms of innovation really being at the core, but definitely something to consider. And we're considering this route more and more for our clients. And then just to round it out with the partner route. So for a lot of these immigration routes I've touched on, you can take your family, which is great. And that includes unmarried partners. This partner route is specifically for partners of people who are British or settled in the UK. So if you have a couple, one is British, other American, you're looking at leaving the US and going back and relocating to the UK. This is a very good route. So I will conclude there. I know we're coming to the top of the hour, and there are a couple of questions in the chat. So is that, Alice, is that okay? Should we address some of those if people have?
Yes, if we can.
Do that.
Do you want to run through those? I think Mohammed was the one at the top, which is for, I think, a question for Kenzani, I think.
Yes, this is for Kenzani. So basically, what category would you be looking at for someone who is a senior manager in Big Four? For example, exceptional abilities, so maybe the O visa, but I'll pass over to you.
Okay, so it depends on whether we're looking at a non-immigrant temporary visa or a green card. For non-immigrant visas, a senior manager would most likely qualify for an L1 visa, but you would have had to have been employed by a related entity abroad for 1 year within the last 3 years, or the 3 years preceding your transfer to the US. And if that is not applicable, then we would look at alternate options such as the O1 if you have quite a high profile, awards and whatnot, or the E2 if you are a national of a treaty country. On the green card side, we would look at EB1 for specifically EB1C for multi-level managers. But much like the L1, you would have had to have been employed in a managerial role abroad for 1 year in the 3 years preceding your transfer. And then if that is not the case, then we would look at either EB2 if you have a graduate degree, or EB3 if not.
That's great. Thank you. And then picking one out for Hunter, can the exit tax be applied against capital gains tax on a later sale of property when someone leaves the US when their green card expires?
Thank you. Yeah, if I understand what you're asking is there for certain long-term green card holders that have been in the U.S. more than 7 of the past 15 years, there's an exit tax that potentially applies to them where their assets are marked to market and a tax is applied on a deemed sale of their assets subject to an exclusion amount. Assuming that the green card holder meets the requirements of being subject to this tax. So the short answer is yes, if you're saying, so if a gain was recognized on a deemed basis on a piece of property in the US, essentially you would get credit for that gain and you would increase the basis by the amount of the gain. So when you sold it again, you wouldn't recognize the gain again. When you sold it in reality and not on a deemed basis down the line.
Okay. So I know there are a couple of ETA questions, but I don't know if we want to wrap things up there, Alice, and maybe we can follow up with anybody. I know
Yeah.
you should have our contact details.
That would be great. We'll circulate everyone's contact details afterwards as well. And I think the question about the slides, I will just ask the panelists now if you're happy to share your slides in a PDF format for us to get out to everyone ahead of time, I mean, after the event. And I don't think we'll be, unless we have your permission, everyone's permission for the recording. We did take a recording for internal purposes, but if you would like to have that recording made more widely available, let us know. We can put that into a YouTube format, protected area, and send that post-event as well. And do you want to take those quick ETA questions now? One was, I think, about before and after the Feb 25th date, I think, from Hannah Gilchrist.
Yes. So it's a good question. They are enforcing the ETAs from that February date, but we'd still recommend getting the ETA if you're traveling now, which we have been doing for all of our clients just to avoid any issues. Get that ETA in place. If you don't, potentially you may not have issues. You may still be able to get on that plane and enter the UK, but it's still a risk. And then there was a question about dual citizens. Can they travel back to the UK on their UK passport? Yes, you really must do that. If you're British, enter the UK on your British passport, and then you're not going to be asked those questions about the ETA.
And likewise, the American authorities like you to use your American passport when entering into the US as well. You can get into trouble if you don't have your US passport.
Exactly. So I think you're having to travel with both passports.
Yeah, use them both for each respective entry. Yeah.
Yeah.
I'm going to ask everyone to pause there and just thank you all so much for joining us today, to the audience. And thank you to Jennifer, Kinsani, and Hunter for your very thorough presentations and advice. We will share those slides with everyone afterwards in an email. So thank you for your time today.